We're back on Morning Trade Live. We'll get a closer look at the home improvement trade tomorrow morning when Home Depot reports its earnings. And it's been a rough go for those stocks this year. Home Depot and Lowe's both down more than 5% in 2025, while Floor & Decor and Builders First Source are both down more than 25% year to date. So let's go inside out on Home Depot ahead of tomorrow's earnings. Joining us now is Skye Canaves, who's the principal analyst at eMarketer. Thanks so much, Skye, for joining us today. So what are your expectations for Home Depot come tomorrow with this report card?
So we expect to see fairly modest growth in light of pretty tough year-ago comps. They kind of reversed their big slump that they were in for a while. And conditions are much more challenging now. So we're also expecting to see fairly conservative guidance. We know Q4 is typically pretty slow for the home improvement sector, as people don't really start major projects at the end of the year in the wintertime.
Yeah, you raised an interesting point in your notes about how this company is not insulated from the bifurcation we're seeing right now, certainly as far as the consumer is concerned. Do you think that the higher end, sort of spenders right now can help mitigate or offset some of the other challenges we're seeing out there?
They've been really reliant on the more affluent households who are, of course, benefiting from increases in their home prices. They tend to own homes. They've also benefited from the run in the equity markets. But even those consumers, I think, are taking a bit of a wait and see approach. There's a lot of project deferral taking place. Smaller projects are still being conducted, but particularly where home improvement projects require financing with the relatively high interest rates and concerns about where the economy is headed, consumers are still really cautious.
Okay, so between the struggling housing market, I mean, even though we're seeing signs of growth, it hasn't really turned around in sort of a meaningful way as much as everybody had anticipated, even with some of these interest rates coming down. You're talking about the K-shaped economy, maybe more affluent people sort of pulling back on their spending, et cetera, and all the other sort of consumer trends we're seeing there. What has this company got to say to mitigate some of these challenges we're seeing right now as far as sort of the more sort of cyclical exposure?
So they do have some significant advantages in their scale. They've made some heavy supply chain improvements, and they've had some recent B2B acquisitions that are really targeting the pro consumer and helping to insulate them a little more from the DIY or more struggling, less affluent consumer. They're really making gains in e-commerce. We expect strong performance there again this quarter, particularly as they speed up delivery speeds and enhance their fulfillment network to make them a go-to source and really help drive repeat purchases online.
And where does Home Depot sort of sit amongst the bunch? I mean, when we talk about some of the competition out there, I mean, we mentioned Lowe's. How is this company sort of positioned within the market?
They're really the two big players. We expect Home Depot is investing a bit more in enhancing its pro, which I think has been a strength for Lowe's traditionally. And so Home Depot is still trying to capture a bit more of that share.
Okay. Good look at Home Depot ahead of its earnings that are coming out tomorrow. Skye, thank you so much for joining us today. Skye Canaves, who's the principal analyst at eMarketer. I appreciate your time. Let's trade it now with Tom White, host of Fast Market. So an example trade for us. Good morning to you, Tom, for Home Depot ahead of earnings. How are you looking at this one?
Yeah, the stocks pulled back pretty significantly from the all-time highs. Remember, they hit all-time highs in this report a year ago, and we've kind of fallen off down about 18% from those levels over the last 12 months. So expectations of bar relatively low at this point. The option market pricing in about a plus or minus about 4.5% move or so, maybe $15.50 either way in the shares post earnings. Now, typically over the past few quarters where they've missed same store sales numbers, growth has slowed. They're usually pretty shareholder friendly. A lot of buybacks, dividend hikes for this company. So that's kind of supported the narrative that when the housing market turns around, if it ever does, they'll be okay in this space. But so with that in mind, we're almost in bear market territory, that pullback. If you're more bullish on this name, but maybe you'll want to be a little bit more passive, a little bit more conservative in your strategy, this type of strategy takes advantage of a neutral to bullish stance. I went out to the November 21st monthly options that expire in just 4 days. So really short-term positioning on this trade, taking advantage of the higher implied volatility levels going into the report. where I'm going to sell the out of the money 350 strike put. It's about $10 below the current share price. And then against it, because we like to stay risk defying going into earnings, buy the 340 strike put. So a short, neutral to bullish, $10 wide put vertical. You're going to collect roughly about a 210 credit on it. That's what you can make, $210 per spread with about $790 in risk on this. But why is the risk so much larger than the potential reward on a strategy like this? Well, I mentioned the fact that it's more conservative because you've got a better probability of success. If you look at the break even on this one, just below 347.80 or 348 on this one, just below that level, that gives you that better probability of success. The probability that that short 350 strike will be out of the money at expiration, which is what you want. You want it to remain above 350, about 68%. So that higher probability of success allows you a little bit of room to the downside, cushion to the downside before you start getting hurt on a trade like this. You profit the stock if the stock goes up. You profit if the stock consolidates here or even goes lower. That break even of 347.90 to the downside, that's about 3.5% below the current share price. So just underneath what the one standard deviation move that the option market is pricing in on this one. But this is what we talk about with trade-offs on this. You're risking more to make a little bit less, but you're giving yourself a better probability of success.
Okay, a good look at Home Depot ahead of its earnings this week. Thank you so much for an example trade for us this morning, Tom White. I'll catch you a bit later on. So.